The Federal Reserve only controls the Fed funds rate. That is the overnight rate. That really only affects the big banks, right? The bond market determines the rest of the yield curve. And so let's go back to last September, where over the course of 2 or 3 months, the Fed cut by 100 basis points. Again, that's just fancy finance speak for they cut by 1%. And we saw an increase in the yield on the 10-year of 1%. So basically, they went from a negative slope on the yield curve and an inverted yield curve where you had high short-term rates and low long-term rates to a normal yield curve where you have low short-term rates and high long-term rates. But that wasn't how they wanted it to happen, right? They wanted the yield on the 10-year to come down. The bond market pricing in higher expected future inflation basically said, yeah, we don't believe you. You can cut all you want, but the cost of capital is the cost of capital. And that's the thing I think a lot of people don't understand.